So far, we've focused heavily on how banks prepare to survive short-term stress, particularly through the liquidity coverage ratio. But liquidity risk isn't just about what happens over the next 30 days. It's also about the long-term structure of the balance sheet. In other words, how stable a bank's funding is in relation to the assets it holds. In this session, we're going to explore the second major pillar of global liquidity regulation, the Net Stable Funding Ratio, or NSFR for short. We'll break down how it works, what it measures, how it's calculated, and how banks adapt their funding models to meet it. We'll also explore its interaction with business models, profitability, and risk appetite. By the end of this session, you'll have a detailed understanding of how the NSFR complements short-term measures and helps to protect banks from structural liquidity risks over a longer horizon. The NSFR was introduced as part of the Basel III reforms, just like the LCR, but it serves a different purpose. While the LCR focuses on a bank's ability to withstand a 30-day stress event, the NSFR looks at a one-year time frame. Its goal is to reduce funding risk by ensuring that banks do not rely excessively on short-term, unstable funding to finance long-term or illiquid assets. It's about maturity transformation, not just in theory, but in measurable practice. Now, at its core, the NSFR is a simple ratio. The amount of available stable funding divided by the amount of required stable funding, and it must be at least 100%. In other words, a bank must fund its longer-term activities with a sufficiently stable pool of liabilities. Now, the more stable the funding source, the more credit a bank gets for it. The more illiquid or long-term the asset, the more stable funding it needs to support it. Now, this pushes banks towards safer, more balanced balance sheets. So let's start with the numerator, available stable funding, or ASF for short. ASF reflects the portion of a bank's funding base that is expected to remain in place for at least 1 year, even under conditions of stress. Different sources of funding are assigned ASF factors, which represent their perceived stability. Now, these factors are regulatory estimates based on empirical evidence from past crises and behavioral assumptions. So retail deposits receive the highest ASF factors, typically 90 to 95%, because they tend to be sticky and resilient. Even under stress, most retail customers do not withdraw their deposits entirely or even at all, particularly if those deposits are insured. Corporate deposits from small and medium-sized enterprises are also treated favourably, though with slightly lower ASF factors. Large corporate and financial institution deposits, especially if they are short-term or operational in nature, receive lower ASF factors, often 50% or less. Longer-term debt instruments, such as bonds or term deposits with maturities over 1 year, are treated as fully stable and receive a 100% ASF factor. Equity, including common shares and retained earnings, is also considered stable funding. On the other end of the spectrum, short-term wholesale funding, particularly that maturing in less than 6 months, is considered highly unstable and receives little or no ASF credit. Derivative liabilities are also treated conservatively, often receiving zero ASF credit as well. Now let's turn to the denominator, required stable funding, or RSF for short. This is where the asset side of the balance sheet comes into play. Each asset is assigned an RSF factor, which reflects how illiquid or long-dated it is. The idea is that the more difficult it is to monetize an asset in a crisis, or the longer it takes to repay, the more stable funding the bank should have in place to support it. For example, cash and central bank reserves receive a 0% RSF factor. They are already liquid and don't require stable funding. Similarly, assets expected to be repaid within 1 year, such as short-term loans or interbank placements, receive low RSF factors, typically 10 to 50%. But longer-dated loans, mortgage portfolios, and other illiquid assets receive RSF factors of 65 to 85% or even higher. Now, these are the assets that tie up funding for longer periods and pose greater refinancing risks. Assets that are encumbered, meaning pledged as collateral, receive higher RSF factors because they are less accessible. Now, off-balance sheet exposures also contribute to RSF. For example, undrawn credit facilities and guarantees require stable funding because they can be drawn down under stress. Derivative assets, just like derivative liabilities, are treated cautiously, particularly where they involve collateral or long settlement times. Even certain securities held for trading or liquidity purposes may require stable funding, depending on their characteristics. Now, once the ASF and RSF components are calculated and weighted, the bank divides ASF by the RSF to arrive at its NSFR. A ratio of 100% or higher means the bank has sufficient stable funding to support its long-term and illiquid assets. A ratio below 100% indicates a structural funding mismatch, where the bank is too reliant on short-term or unstable liabilities to fund assets that take time to mature or sell. Now, one of the biggest differences between LCR and the NSFR is timing. The LCR is about short-term survival. The NSFR is about long-term sustainability. A bank could have a strong LCR, lots of liquid assets and low short-term outflows, but still have a poor NSFR if its funding base is too short-term relative to its asset book. This distinction is important. It means that liquidity management isn't just about daily operations. It's also about strategic funding decisions, product design, and business model planning. From a management perspective, the NSFR influences how banks think about funding strategy. For example, it encourages banks to issue longer-term debt, such as 3 or 5-year bonds, rather than relying heavily on overnight or one-week repo. It also incentivizes banks to maintain strong retail deposit franchises, which provide stable, low-cost funding. At the same time, it discourages excessive growth in long-term illiquid assets unless those assets are matched with appropriately stable liabilities. The NSFR also affects product pricing and design. For example, a business unit that wants to grow its long-term mortgage portfolio may be asked to contribute more to funding costs or to limit growth unless stable funding can be sourced. Funds transfer pricing systems reflect this by allocating internal funding charges based on asset RSF profiles and funding ASF contributions. Now, this creates a feedback loop between risk, finance, and commercial strategy, ensuring that liquidity considerations are baked into business decisions. Now, from a regulatory standpoint, the NSFR is now part of the global minimum standards under Basel III, and it is being implemented across major jurisdictions, including the UK and EU. Now, in the UK, the PRA requires banks to report their NSFR regularly, both at consolidated group level and at material legal entity level. Supervisors assess NSFR as part of the wider SREP process, alongside the LCR, ILAP, and other risk indicators. Regulators may also set Pillar 2 requirements or expectations where NSFR falls short or where a bank's business model creates concerns about structural liquidity risk. For example, a bank that relies heavily on volatile wholesale funding or that has large concentrations of illiquid assets may face increased scrutiny or additional reporting obligations. Supervisors may ask for remediation plans, targeted stress testing, or additional disclosures to investors and the market. Now, banks respond to this in several ways. First, they maintain internal NSFR targets, often set above the regulatory minimum. Now, these targets provide a buffer against volatility in funding markets, shifts in asset composition, or changes in regulatory interpretation. Second, they regularly rebalance their asset and liability mix to optimize NSFR. Now, this might involve issuing term debt, attracting more retail deposits, or adjusting the maturity structure of the investment portfolio. Now, Treasury teams play a central role here, managing the funding mix, planning debt issuance, and engaging with investors and rating agencies. Risk teams model NSFR under different scenarios, such as interest rate shocks, asset growth, or funding disruptions, to understand how sensitive the ratio is and where vulnerabilities lie. Finance teams align NSFR with balance sheet strategy and profitability targets. The goal is not just compliance, but resilience and adaptability. Now, it's worth noting that the NSFR is not a daily operational tool like the LCR. It's more of a strategic ratio, calculated on a monthly or quarterly basis and used to inform long-term planning. But that doesn't make it less important. In fact, some of the biggest liquidity crises in history have resulted from structural mismatches that the NSFR is designed to address. The collapse of Silicon Valley Bank, for example, highlighted what happens when a bank finances long-term assets with short-term, non-sticky deposits, particularly in a rising interest rate environment. Now let's talk briefly about some of the practical challenges in managing the NSFR. Now, one is data granularity. Because the NSFR relies on maturity profiles and behavioural assumptions, banks must have detailed, accurate data on their assets and liabilities across currencies, legal entities, and business lines. Another challenge is forecasting. Since the NSFR looks ahead 1 year, assumptions about rollover behaviour, prepayments, and customer drawdowns become critical. Now, if these assumptions are wrong, the bank may find itself with an unexpected shortfall. Now, there's also a challenge of incentives. Business lines may not always see the full cost of stable funding, especially if internal pricing isn't aligned. Treasury and risk must work together to ensure that pricing reflects true liquidity cost and that businesses are incentivized to fund themselves sustainably. Otherwise, the bank risks creeping back toward the same maturity mismatches that have triggered past crises. And finally, there's the global dimension. NSFR must be met not only at group level, but also in material subsidiaries. And regulators may impose local requirements and add-ons. Now, this creates complexity for banks operating in multiple jurisdictions, especially where liquidity is fragmented by legal, regulatory, or currency barriers. Now, group treasury must coordinate with local entities, balance efficiency with compliance, and ensure that funding strategies support both local and consolidated NSFR requirements. To wrap up this session, the net stable funding ratio is a vital part of modern liquidity management. It shifts the focus from short-term shocks to long-term sustainability, forcing banks to think carefully about how they fund themselves and how they grow. It discourages excessive reliance on volatile funding sources, and it promotes a healthier, more balanced banking system. Now, while the LCR tells us whether a bank can survive the next 30 days, the NSFR tells us whether it can do so again next year and the year after that. Now, in our next session, we'll step back from the quantitative metrics and explore the qualitative side of regulation, the Internal Liquidity Adequacy Assessment Process, or ILAP for short. Now, this framework requires banks to demonstrate not just what their numbers say, but how they understand, govern, and plan for liquidity risk. It's about narrative, oversight, and credibility. In session 7, we'll look at what a good ILAP looks like, what regulators expect, and how firms use it to build trust and resilience. I'll see you in the next session.